Larry Shover is with us, the CIO at Efficient Advisors. Mr. S, always a pleasure to see you, especially ahead of the weekend. What are you doing in bonds right now after this big rally that we had?
Well, just wait and see mode. I mean, everybody's throwing rocks at the Fed, and I really don't understand it.
Me neither, Larry.
You think of this whole year in review. Yeah, you think of this whole year in review, the lack of realized inflation is one small factor in Bearmageddon that everybody was talking about. This was a year for synchronized global growth. Never happened. This is a year that the ECB was going to start tightening. That never happened. How about the capital expenditures revolution because of the tax reforms? That didn't come to fruition either. So, how can you ask the Fed to pause right now on the inflection point when you have full employment, when you have break-evens at two-year lows, when you have unemployment below 4%? It's hard to believe, but that's the world we live in right now.
Larry Shover coming out spitting fire today. I like it. So, Larry, let's ride this through a little bit, because I also think what you're touching on is something so hugely critical that I don't think has been given personally enough appreciation, which is the 180-degree turn the economic narrative has taken since February. It, to me, doesn't feel very long ago when we had Vixplosion and we had everybody at Davos talking synchronized growth and interest rates going up, all right? And now everybody wants to say they understand the economy better than the Fed, where back in January, they all thought it was synchronized growth too. So maybe it's just tough to figure out, and let's not go head over heels about wrong or right, and maybe just understand the way the market responds.
Yeah, exactly. I mean, the Fed, over history has a very poor record. We all have a poor record of picking the inflection point of a market and when to pause. The communication risk is huge. I do think that Powell will continue to hike until something breaks. And if you qualify the S&P 500 being down 8% for the year broken, then he'll pause. But I don't think he will. And not yet. I think there's one more hike left in him. That said, it's amazing the despondency in the market with global growth. And as you said, in February, everybody was cheering, high-fiving, and this is the year that's going to happen, and it just failed to come to fruition. What I'm surprised the most at is that it took so long for the market to come to its senses, to realize that, hey, this is not the year for that.
Larry, so as a trader then, how are you approaching this? Because I know you were bullish on bonds when a lot of people were bearish, and we've had multiple rallies. Where now we got to go back to the spring to get to the level on the 10-year. So do you think there's still more buying to come? I mean, are you buying bonds, or are you now going, look, it's got to go the other way, went too far, I'm shorting them?
Yeah, no, it's still, to me, right now, it's the yield curve. I still would rather take a flattening position. I've been, on that flattening narrative for probably the past 3 months. 210, 530, looking for that. I mean, I believe in my heart that we definitely could see a retest of the high yield in the 10s and the 30s in the next 3 to 4 months. That will be the buying opportunity, because then again, we're in the same boat as we've been before. We have fiscal deficits. We have, our rates would be attractive, et cetera. It's the same narrative. Markets aren't ruled by the calendar. So if 10s and 30s get back to their highs and yields, to me, it's just another buying opportunity. Right now, it's more about the yield curve and not the absolute level at 279.
Yeah. All right. We're getting closer to inversion on the long bond by the day here. We already knocked off the short end. Hey, Larry, we got to leave it there. Quick but smart, as always. Appreciate it, Mr. Shover.
Thank you.
Larry, have a great weekend. Have a great holiday. Mr. Shover is the CIO at Efficient Advisors.